Investors, as you know, every single week I produce at least one video for you all, which I break down either the 5 or 7 dividend stocks that you should add to your watch list or buy based on their discounted share price. But today, I owe you an apology. You see, before you load up on individual stocks, you should be building an insanely reliable investment portfolio foundation. Now, how in the world do you do that? Simple. In 3 words, exchange-traded funds, or ETFs for short. These funds are a type of pooled investment security that generally track a specific index. So instead of investing into a single share of a company, you're really investing into a basket of shares, which makes ETFs fail-safe investments. If you're new here, I'm Ari, a value and dividend investor on YouTube, here with a mission to help you reap more success as a dividend investor, whether it's with stock ideas or market insights. And as for today, I have 5 dividend ETFs that you can earn some serious passive income with this year and beyond. But before we dive in, if this video brings you any value, help me in reaching more dividend investors by tapping on the thumbs up button. And if you want weekly discounted stock ideas, then also tap on that subscribe button to join me on this journey. Without further ado, let's dive right in. So I mentioned that ETFs are ideal investment portfolio foundations because they allow you to invest into a basket of companies in one shot versus trying to pick the winners and likely failing to do so. But I also want you to know that whether or not the market is up, down, or anything in between, ETFs allow investors to simply invest it and forget it, which means you can truly invest passively without having to look at your account every day of every hour of every waking minute. However, amongst all the thousands of ETFs out there, we still need to be careful and avoid the ETFs that aren't performing as well, which has led me to this very video. Now, before I get to the 5 dividend ETFs today, it's important to note that these are dividend ETFs, meaning you won't only be capitalizing on the appreciation of the share prices in these ETFs, but you will be receiving dividends all along the way, meaning even more profits for doing nothing. Now, with that said, let's dive into our first dividend ETF, the iShares Core High Dividend ETF, ticker symbol HDV, which seeks to track the investment results of an index composed of relatively high dividend-paying US-specific equities, and more specifically focuses on very established high-quality companies for the sake of reliability and consistent long-term income. As of this video, HDV has 76 total holdings, with some of the top holdings being ExxonMobil and Johnson & Johnson, followed by Verizon, Chevron, and AbbVie. But let's talk about the power of the fund with its dividend, as it has an average yield of 4.3%, which is not too shabby. Now let's talk about the dividend ETF's returns. Over the past 10 years, HDV has returned 8.37% on an annual basis, meaning if you had $10,000 and invested it 10 years ago, it would be worth a little over $31,589 today, which leads me to talk about the expense ratio, because nothing in life is free, but luckily with HDV, it's pretty close to it, with an expense ratio at 0.08%, meaning you only pay $8 per year on $10,000 invested. Up next, I want to dive into a Vanguard fund, which is already highlightable based on the fact that it was Vanguard's founder, Jack Bogle, who was also the founder and father of index funds and believes strongly in low-cost funds for all retail investors. So you can bet that this next one will deliver more bang for your buck. Nonetheless, we have the Vanguard High Dividend Yield ETF, ticker symbol VYM, which seeks to track the performance of the Financial Times Stock Exchange High Dividend Yield Index, which measures the investment return of common stocks of companies solely characterized by high dividend yields. All in all, VYM is meant to provide investors with insanely convenient ways to track the performance of stocks that are forecasted to have above average dividend yields. Now, VYM currently has 466 holdings within it, with the top holdings once again being ExxonMobil and Johnson & Johnson, yet followed by JP Procter & Gamble, as well as Chevron and many more. Now, in regards to VYM's dividend yield, it's averaging 3.09%, but it also ensures that investors aren't paying as high as an expense ratio, coming in at just 0.06%, meaning if you invested $10,000, you would only need to pay $6 per year on the $10,000 invested to cover your bases. Which, by the way, if you did in fact invest that $10,000 10 years ago, you would be sitting on roughly $26,287 today. As for our third dividend ETF, I want to dive right into the S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL, which should immediately clue you into the holdings within this ETF by seeing Aristocrat in the name of the ETF. And for those of you who don't know, a Dividend Aristocrat is a stock that has been paying dividends out consecutively for over 25 years while increasing their dividend year over year. Therefore, the S&P 500 Dividend Aristocrats ETF is a fund that focuses on the S&P 500 Dividend Aristocrats, which are some of the highest quality dividend paying companies that have a 25+ year history worth of paying dividends, with most of the holdings actually doing so for more than 40 years. Now, this fund has demonstrated a history of weathering market turbulence, making it ideal for economic uncertain times, with a total of 67 holdings within it, and some of its top holdings being West Pharmaceutical and W.W. Grainger, to Clorox Company, A.O. Smith Corporation, and Lind. But what matters most is that return on investment. So if you invested $10,000 into NOBL 10 years ago, you would be sitting on roughly $27,872 today, which equates to about 11.76% of an annual average return. And as for the current fund's average dividend yield, it's coming in at 2.05%, which all sounds great. The one major downside to NOBL is actually the expense ratio, but perhaps price is what you pay, whereas value is what you'll get here, with an expense ratio coming in at 0.35%, meaning you only pay $35 per year on $10,000 invested. Moving on to one of the most powerful dividend ETFs that is also Vanguard backed, it's the Vanguard Dividend Appreciation ETF, ticker symbol VIG, which tracks the performance of the S&P US Dividend Growers Index with an emphasis on stocks with a record of growing their dividends year over year that are also predominantly large cap equities for sustainability and reliability purposes. As of this video, VIG holds 317 holdings within it, with some of the largest positions established in the fund being Microsoft and Apple, which are not your traditional dividend stock mentions in these ETFs, but add some real profitability to your returns, along with holdings like ExxonMobil, United Health Group, and Johnson & Johnson. Now, here's where the magic happens with a fund like the Vanguard Dividend Appreciation ETF, with a dividend yield a little lower, averaging 1.89%, but with plenty of growth given the more growth-oriented holdings. If you invested $10,000 into this fund 10 years ago, you would have experienced an average annual return of 11.09%, ultimately meaning your $10,000 would now be roughly $28,626. And all for a low cost, given the expense ratio is coming in at 0.06%, meaning you would only pay $6 per year on $10,000 invested. And last but not least, we have arguably the most well-known dividend ETF that has been a rock-solid performer year over year, the Schwab US Dividend Equity ETF, ticker symbol SCHD, which seeks to track as closely as possible the total return of the Dow Jones US Dividend 100 Index and offers investors a straightforward, low-cost fund that also aims to be as tax efficient as possible. Overall, every investment with SCHD is selected for fundamental strength relative to their peers, and all based on financial ratios as well as dividend sustainability. Now, currently SCHD has 102 total holdings within the fund, and some of the top holdings being AbbVie, PepsiCo, Merck, Coca-Cola, and United Parcel Service, or UPS for short, to name a handful, but plenty more heavy dividend hitters. As for SCHD's dividend yield, it averages around 3.52%, which you may be getting a higher yield elsewhere, but I am not so sure about the reliability with other funds. And while we're talking about returns, if you invested $10,000 10 years ago, you'd be sitting on roughly $30,412 today, which works out to a cool 11.26% worth of an average annualized return rate. Now, on top of that, you would only have to pay $6 per year for $10,000 invested, given their expense ratio is coming in at a low of 0.06%. And there you have it. 5 dividend ETFs that you can invest into passively and with confidence over the long term to reap a solid return on investment. Now, remember that investing always comes down to performing your own due diligence and picking the right ETF for the foundation of your portfolio. Now, if you're about to invest into any one of these ETFs, or if you've already invested into one of them, or heck, all of them, let me know by commenting down below. But moreover, if today's video brought you any value whatsoever, do me a massive favor in helping me grow this channel and reach more dividend investors by simply tapping on that thumbs up button for the algorithm. And if you haven't already, you can join me on this journey by subscribing as well. Now, investors, until the next video, I will see you all there.